All right, guys, so look at this lineup that we have here at Sachs Realty. We have Travis from Real Estate Mindset. We have Melody Wright. You guys all know who she is. She has a Substack. We have Jack, who's nobody special, runs a awesome YouTube. And then we have Melissa here. And if you're wondering why Melissa's not wearing one of her Sachs Realty shirts, is because Travis and Melissa decided they were going to change outfits for this. Travis was actually wearing a dress, but I mean, you can even see Melissa had to give him socks because, he didn't have socks on. But anyway, we're going to just kind of do a little Q&A, a little random stuff, bring you guys a little special treat. And the market is literally falling apart. Sales are way down and inventory is coming up and interest rates are bouncing back up again. And we'll probably be looking by the time that this video airs that we may even be well over 7% for the mortgage. But we'll kind of start off by just introducing everybody, and then we'll get started and give you guys some questions and find out what's in their heads. Travis.
Yes, sir.
Tell everybody who you are. I can't believe that they wouldn't know, but for those that don't.
I'm just a normal person trying to warn people. But really, guys, one of the things I want to say, though, talking about solution, talking about initiative and empowerment and things like that, I have made a free home buying course, absolutely free to you guys to talk about credit, income, assets, what to ask a seller for. It's absolutely free. I want to teach you guys how to say no, and more importantly, how to say yes when it comes to buying a house.
All right.
Hi, I'm Melody Wright. I am a housing analyst. I focus on commercial and residential real estate and mortgage finance. And I write a Substack and also have a YouTube channel where I talk about what's going on, the underlying dynamics that really impact that home buying decision that most people don't even know anything about. So,
all right.
I'm Jack Gamble. My YouTube channel is called Nobody Special Finance. My background is mechanical engineering, worked in nuclear power for 15 years. No formal finance pedigree, but I live in numbers and charts, and I like to go look for patterns and spot something before it breaks.
Now, Melissa.
I'm Melissa Levy. I'm Todd Sachs' assistant here at Sachs Realty, and I've been here for almost 6 years. In the beginning, there was no podcasting, and now I come to you live every Tuesday night.
That's right. So Melissa and I will try and head up some questions here. And I'd like to actually start with Melody because, Melody, a lot of people say that we're doomsdayers and that we're predicting this crash that never happens. And so what do you say about that? And we'll start with that.
yeah, listen, all I'm trying to do is just to bring awareness and education. And so if the data starts changing, if we see, something else on the horizon, I'll be the first person to talk about it. But I think for those of us that have this experience, it's very upsetting what we're seeing, especially when you go out on the road and you hear things like there's no inventory and you see these massive development sites. I mean, 1,000 homes basically in a very small area while there is existing is on sale and not on the listing side. And so, we're just trying to bring awareness to what's going on and the way that the data is not really representing the true picture. And if the data starts changing, I'll be the first one to talk about it.
Yeah. So do you think that's doomsdayer?
I don't think so at all. I think that's just, guys, I'm actually a very positive person. I try to see the best in everything. But what I don't want to happen is someone to make a decision based on this misleading information that's going to impact them for the rest of their life.
Yeah. Travis, do you think people should wait before they buy a house? Wait until expecting price reductions?
I think overall the answer to that is yes, but I definitely think everyone has a unique situation. I think some of the things that people should be looking at before buying is no consumer debt, having maybe 6 months saved for an emergency, and having realistic expectations. Can you afford a payment for 30 years? How much money is this going to cost out of my pocket? But one thing, we don't want is blind optimism from consumers because the industry is set up to take advantage of reckless consumer spending. Obviously, our economy is ran by consumer spending as well.
Yeah. Jack, you talk about finance on your channel. You go live every day and right before the stock market opens up, right?
Yep.
The market's open. And, you and I have spoken many times about inflation and, in our conversation with disinflation and the fear that, you know, the Fed dropping the rate too soon could result in some bad implications for inflationary times to pick back up again. What do you think about the Red Sea crisis and how that will, in the midst of everything else that's going on, where we're finally starting to get some downward pressure on prices year over year, what do you think that's going to do in the near term for us, or nothing?
It's certainly not going to help with inflation. Obviously, very inflationary. Boats having to sail around the Horn of Africa. It's going to add to the lead times. It's going to take longer to get things. It's going to add to the cost of transit, more fuel consumption. So it's going to drive up prices, or at least put upward pressure on prices, I should say. Whether that actually translates to higher prices or not, that's up for debate. My gut tells me we're actually in for a serious bout of deflation not too long from now. As the Fed has been raising interest rates and doing quantitative tightening, destroying money, for the last 7-8 months or so, the reverse repo has been draining. And that is trillions of dollars that was printed during the pandemic that never got circulated into the economy. It's been on Mars, essentially. And that money is flowing back into the economy. And that money is chasing assets. It's driving down interest rates. They're buying bonds with it. And it's actually more money has re-entered circulation through draining the reverse repo in the last few months than the Fed has taken out in all of their quantitative tightening. So we are yet to feel one penny of the Fed's quantitative tightening to fight inflation yet, because the reverse repo has more than offset that, which means, everybody's saying, oh, is it almost time for them to pull back? It may already be too late for them to start cutting, because the damage has been done. I use the metaphor, you stubbed your toe, that pain is coming. It's just going to take a second or two. And I think when the reverse repo finally drains, that starts the clock. Maybe it's not an instantaneous thing, but I think that's going to lead to higher interest rates, and higher interest rates could lead to deflation and eventually lower prices.
Melissa, you've been here, you said almost 6 years. Obviously you've seen a lot of transition where we've gone from the highest point of the market to now dipping down into some of the lower points since you've been here. Yeah. And so you started sometime, around June of 2018. It was fast pace. It just went up from there. So what are you seeing from the calls that are coming in, the leads, dealing with, because you deal with a lot of the buyers and sellers. They're initially speaking with you when they call in. What's the sentiment now compared to how it was?
Well, the majority of the callers that call in are so appreciative of the information that we are putting out there to the public, because they are not hearing it from mainstream media, and it needs to be said, and they're seeing it firsthand themselves as well. And people really, really need help. There are so many buyers out there. The demand is enormous on how much true help that they need, and legitimate help. I can just say firsthand, I have conversations with these people, and they are really feeling the struggle and the pain for these past 2 years. So I will say, if anything, it's truly weeded out this crazy time of people putting on the brakes and not being impulsive as much as they once were, and being more strategic and planning when it comes to making their financial decisions.
Yeah, so they're not feeling the pressure, the FOMO, the exuberance that they were.
Definitely not, and they're smarter and wiser now.
Yeah, they can see now that their peers have made some pretty tremendously bad mistakes. Right?
Yeah.
Melody, when in 2007, and I know we were, I think, and Travis too was in the business, during the great financial crisis, but when the Fed dropped interest rates in 2007 to 1%, it didn't work.
That's right.
So now we're looking at the Fed lowering rates this year. Is it going to work this time?
I don't think so. I think the distress is too high right now. I think, similar to last time, property taxes, insurance they're increasing, and they're increasing very quickly. And the insurance piece is really concerning. insurers leaving states like California and Florida, people being told they can't, get insurance on their home. And then in the business, we hear recently a lot of people saying, hey, they were going to close on this loan. They saw the insurance and they're not going to be able to do it. They're not going to be able to finance it because of that increased cost. And so, I will have clients who are servicers and we're seeing escrow notices that go out sometimes, and this is not an exaggeration, doubling the mortgage payment. And so when you have that kind of stress and we're seeing early delinquency in FHA and sort of the, more private investor market, and we're seeing that delinquency in what we call conventional or Fannie and Freddie, it ticked up last quarter as well. And we're at delinquency levels of Q3 2006. I don't think the Fed is going to change anything for those homeowners that just cannot afford to pay their bills and to pay their mortgage.
Travis, you've been in the mortgage industry for over 20 years, so you've seen a lot of changes. Obviously, people made mistakes back before the great financial crisis. Are you seeing as a repeat in that setting up for something that we both believe, I think everybody believes that, sitting at this table, that we're going to see something not good in the housing market? You can't put your exact finger on it. It doesn't have the exact footprint of '08, but it has maybe some of the footprint of 1929, which is even scarier still. But what are you seeing that is probably like the largest mistake that buyers are falling back into when it comes to buying a home with a mortgage?
Well, I mean, not having the proper expectations, not taking an initiative to learn the process. And I would say the biggest difference from then until now, and I had a career in both situations, is the GFC was more of a refinance thing, right? People were refinancing, cashing out, obviously creating inflation, but cashing out like ATM machines. But what's similar right now that I see, and we don't really see it in conventional yet, defaults, but the unaffordability. The unaffordability right now is worse than it was in the GFC. And I think what's happening is, again, the lag effect hasn't really hit everyone yet to crack and to melt down the economy. And when I really analyze it, it makes sense that it's taking longer. There was much more money. So then we had refinances stimulating the economy. Now we had more bailing out, putting into the hands of consumers, and then they still have equity. Some of them still have equity. But when we look at the ability of consumers to pay back their mortgage, it's as bad as it was in the 1980s. So really, the job market, the labor market right now, and the way that qualification works in mortgages, I mean, I feel like it's still propping up everything. But when we look at debt to income ratio and we analyze the new subprime, which is FHA, and you really start to understand that on the back end ratio, debt to income ratio in FHA, you can go up to 56.99%, which means someone's gross income, not net, before taxes are taking out their gross income, over half of that can go towards their mortgage and their credit card debt. But more and more people are getting into more and more credit card debt, right? So, and then the property taxes ballooning up, homeowners insurance ballooning up. So when you really look at it, I think the debt to income ratio right now is way, way worse than even what's being reported. And the other problem is when we look at data sets like payment to income ratio and it's saying 41%, that's not how loan officers and banks qualify people to afford mortgage. They're giving the data to the public saying, okay, it's 41, whatever percent, but they're not counting really important things like property taxes, homeowners insurance, HOA, which is what we do as loan officers to make sure someone can afford a house. So I think that even with the fact, and it is a fact, more people have equity in their homes now, as long as they purchased prior to 2022. But that doesn't take away from the fact that the unaffordability is out of control right now. And I'm most worried about post 2022 buyers that, depending on the market, are up, and depending on the deal, of course, they're already upside down. There's people already that can't refinance or sell their house as a result of purchasing at the peak of the market and not necessarily being educated enough to make an informed decision. And I don't blame them, Todd, because another thing that's different, well, mine is Ben Bernanke, right? We have everyone saying home values don't go down. Even Dave Ramsey, home values don't go down. As long as you can afford it, buy it. But they're not explaining, what does affordability mean? That's a 30-year, generally a 30-year commitment. And being late on your mortgage just one time is devastating to your credit score and your purchasing power of a consumer. And when you lose your ability to get credit on top of a job or unaffordability, it's going to be bad, man. It happened to me. And I think that, again, I think we're really going to see that as unemployment spikes up. I think unemployment is going to be worse 2025, but the labor market right now is not like the GFC. It was way worse. And we're not in recession yet. But when we were in recession in the GFC, unemployment was I couldn't find a job. People couldn't get seasonal part-time jobs left and right like they can right now. So even though it's weak jobs, not sustainable, no income growth, people still, for the most part, have the ability to go out and find a $15 an hour job.
So, like what Jack, what Travis was saying, Bernanke, who was the chairman, Fed chairman back in the great financial crisis, had right shortly before the crash, or when we started seeing massive foreclosures, said that the housing market would never go down, something to that effect. But we also had in 2023, literally weeks before the banking crash, the March 12th weekend, we had this chairman, Jerome Powell, I believe, testified to Congress saying that the banking sector was strong. And then, here we go weeks later, we have one of the biggest bailouts that we've ever seen, many bailouts already last year. There's a big debt crisis. Where does it show up next?
Mm-hmm. Well, interesting thing, when Jerome Powell made that testimony before Congress, it was about 2 weeks earlier. I don't recall the exact date, but Jerome Powell did sit in on a meeting where a hypothetical scenario was presented at that meeting about risks in the banking sector. And that example was Silicon Valley Bank and massive unrealized losses on U.S. Treasuries due to rising interest rates. That was the hypothetical scenario that was presented to the Federal Reserve to demonstrate rising risks in the banking system. And a few weeks later, Jerome Powell went before Congress and said our banks were strong and resilient and everything was well. And within days of that exact scenario that had been described and handed to Powell happened, and we all saw what happened in March. So these guys are cheerleaders. When they go up and they say strong and resilient, they'll only ever say strong and resilient, no matter how weak it is, because Federal Reserve Chairman saying, wow, this stuff is in really bad shape, that doesn't poll so well. And it doesn't test well in focus groups. Now, what is the weakness now, and what's the thing to watch out for? You mentioned 1929 a few minutes ago. This scenario resembles the Great Depression more than most people realize. Back to what I had said earlier about how the quantitative tightening, and we haven't felt it yet because the reverse repo has been coming in to fill that hole as we've been taking away money. We actually have a shrinking money supply right now. The M2 money supply, all the checking accounts, money markets, it's been shrinking since about April, May of last year. The last time we had a shrinking money supply in this country, 1930. Right after the Great Depression. So we haven't felt the effect yet because that reverse repo draining in has been hiding that. Kind of like the boat is taking on water, but we've got a pump running, pumping it out as the boat takes on water. Well, that pump is about to shut off. And then we're going to be left with a boat taking on water.
So you think we're going to have a banking crisis is going to be what happens next? More bank bailouts?
Absent some bailout, absent them spinning up the money printers again. Zerpenber is what I refer to on my channel, zero interest rate policy, and the sound of the money printer cranking out $100 bills. Absent that, yes, there's another banking crisis. It may not be the same thing we saw in March. That was unexpected. It may resemble what we're seeing in commercial real estate or consumer debt failing in large levels. It could be something like that. It could just be the money, there's not enough money and there's more demand for money to service all this debt than there is money available to do it. And people start outbidding each other for the limited cash that's out there. And that spike in interest rate could start to fail financial institutions.
Melissa, you deal with a lot of real estate agents. We have a lot of leads that come in on our network. And, so if you guys are looking for an agent and you're not in Maryland, obviously we would hope that you would call us if you're in our state of Maryland here. But if you're anywhere else, we have a network of agents throughout the country, and it's growing every day. And we're kind of proud of that because we have some great agents. There's some qualifications that they have to go through to even be eligible.
That's correct.
What would you say, and because you've been dealing with the agents, you're licensed, you contact agents for our agents and myself, what would you say the number one frustration that you have from our industry that just seems to stand out the most and continually be present?
It's agents not answering their phone, I think, is the number one for me. You don't know why I'm calling. You have no idea what the information is going to be on the other end of the phone. And the fact that we are in such a critical time right now, that you would want to be hungry and answer the phone and get, people the necessary information that they need to be able to potentially have a deal in your hand. That is my number one frustration, communication from the real estate agents.
Yeah, we get it. I mean, I showed a house once and not that long ago and called the agent twice. My client had some questions and the listing agent never called me back, and the listing sat on the market for almost 40 days. And, it did not go under pending until weeks after we saw it. And we couldn't even get a hold of the agent that is, and that's the bad part is the seller doesn't see that.
No.
The seller doesn't see that their agent's not calling back. So, if I were the seller, I'd probably try and trick my agent by having a couple friends try and get a hold of them that, at least try and see if they answer their phone for them to inquire about their house, but don't just expect it. Well, let's kind of go around. We'll do like a final round. And Travis, what's the biggest thing that keeps you up at night?
Oh, okay. I'm going to get there, but I want to say it was very interesting. Jack just hit a nerve. So, we say that the bank runs were unexpected, right? In March, right? Yet they did a stress test 4 weeks prior to the same company that went out of business. Interesting to think about that. You light bulb.
Who could have ever seen that coming?
Maybe the actual stress test. I'm gonna tell you, the biggest thing that I fear at night is not the housing market. The biggest thing that I fear at night is my children being raised in a society that is just taught not to pay their bills, is taught for instant gratification and to stay living in a bubble of COVID like it was normal, and to, there's a lack of integrity, man. And I'm really terrified that that my children are going to have to go through that and that they're going to fail. So I'm up at night trying to figure out, how do I remove the anxiety, right? How do I lift it up to God? And how do I raise my children in a way to get ahead of America? I'm starting not to recognize. And I'm terrified. It's becoming social, man. And the American dreams are past. So I'm going to be fighting in my household to maintain integrity, to maintain discipline, confidence, and for my girls and my boy to stand up for themselves and not to follow the rat race. I don't know what's going to happen next with bailing out, man, but I'll tell you that it's not how I was raised.
Melody?
So I think I share a lot of Travis's concerns. I think we've completely disconnected from fundamentals, from what's important in life, from our social fabric, from our relationships. We put too much value on money and things. And, and in some ways we're kind of hapless victims in that way because our economy is so much about consumption. If we stop spending, then that's a big problem for our government. And so that's why we see mainstream media continue to push us into purchases that we simply can't afford. And, obviously the top 20%, they can, but the rest of America can't. And so who's going to be hurt when all is said and done? And so we know low rates help asset holders, but they don't help the 67% of Americans who can't afford a $1,000 emergency. And so I feel very concerned for young families, for younger generations, and, that are just completely missing out on what I believe we're all here for, which is, to help each other, to bring joy to one another and to learn and to grow.
Jack?
The thing that worries me the most is this lean into totalitarianism that we've seen since the start of this wonderful decade. I think the ruling class in this world was amazed at what they were able to get by people in 2020. And so now they're wondering how far they can push it. And there's one major obstacle to that, and that's the middle class. The middle class doesn't want to take over the world. The middle class is not dependent on the government for much of anything. They're notoriously hard to control because all they want to do is be left alone. And so the middle class has to they need to be out of the way. And everything I see, all the underlying weaknesses in the economy, I'm seeing some common themes. You've got predatory borrowers, people who are borrowing money with no intention of ever paying it back, student loans, consumer debt, houses they can't afford. And then you've got predatory lenders who are lending the money to those predatory borrowers, and they don't care because they're not taking the risk. They're just collecting a fee for the service. And then they're working in together, and that debt, through financial maneuvering and an uneducated populace, financially speaking, that debt winds up in the retirement accounts of middle-class people. That is the dumping ground for all of this toxic sludge, all of these loans that nobody's ever going to pay back. It's not the banks lending them the money. It's our retirements that are going to take the hit. And the middle class is being squeezed from both ends right now by predatory borrowers, deadbeats who are spending money that's not theirs on things they're never going to pay it back. The banks that know that don't care. They're lending it to them anyway because they know it's we, the middle class, that are taking the risk.
Melissa?
That could be a fully loaded question because without getting too political, I think the leadership of our country is falling apart every single day, and it does keep me awake at night about what the future is, especially for the younger generations. Mirroring what Travis and Melody said, I do worry about the younger generations not having the same opportunity that we had, our age group, and they so badly want to be homeowners. And right now, that is a huge struggle for them. So that's it.
All right, guys, well, there you have it. A little bit about our panel here. All of their information is in the show notes. If you're not following one or all of them, you may take a minute to do so now. Cruise on over to their YouTube channels, Melody's Substack. We appreciate you watching, and more content to come. We'll see you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.